Restructuring is a dirty word in Europe these days. That's why EU leaders met in Brussels these past 2 days, haggling with Germany over the terms of a permanent bailout fund, one that will keep Europe's most profligate nations from defaulting on debts they simply can't afford. Restructuring, though, is anything but verboten to our next guest. Until last month, Jim Millstein was Chief Restructuring Officer for the U.S. Treasury. Jim is in Washington this morning. Jim, the EU leaders so badly want to forestall any risk of a restructuring or a default, doesn't matter what you call it, until after this permanent fund gets put in place in 2013. What's your sense right now? Will they be successful?
Well, yeah, look, money can cure anything. So you've got the temporary facility is currently in place, and it will hopefully, it should be sufficient to handle the problems that Ireland, Greece, and now it appears Portugal may have. So I think in the short term, they have sufficient resources available to deal with the funding needs of these countries. The real question is whether or not the debt levels that these countries have are sustainable in the long term. And I think that's really an open question. And I think many market participants doubt that these levels are sustainable. Is
it an open question, though? Look, does anybody believe that Greece or Ireland or, as you point out, Portugal can really grow their way out of tens of billions of euros or dollars, doesn't matter what currency you use, in debt? At one point, something's going to have to give, isn't it?
Yeah, that's right. And part of it's the cost of the debt influences that outcome. So if the cost of the debt is higher than the growth rate of the economy and the debt exceeds the size of the economy, then I think it's pretty clear that it's unsustainable. Stein once said, that something can't go on forever, it won't.
Okay, but you raise a very important point, the cost of the debt. Look what's happening in Europe right now. Germany working very hard to limit its commitment, and everybody else's commitment for that matter, to this permanent bailout fund. They've shrunk the amount of start-out capital required, and they're relying ever more on the debt markets to enforce the kind of discipline that the EU would be able to enforce if it had some kind of fiscal authority, which it doesn't. How risky a strategy is that?
It's a very risky strategy. In effect, what the Germans and the EU has done is to put back to the markets the question of what the cost of funding is going to be. And if it proves to be prohibitive for these countries, then these countries really have no choice but to default or to come to the bailout facilities, the ESM. The problem is that the ESM, although offering funding at slightly less onerous rates than the market is currently charging, may simply be throwing good money after bad and refinancing debt that proves to be unsustainable in the long term.
Ultimately, though, what is the incentive for a country like Portugal to subscribe to either? Think about it, right? Even if the terms of the bailout fund are slightly less onerous, as you point out, than the market rates, which today are approaching 8% for Portuguese 10-year debt, the current government, or the one that just dissolved, didn't want to subscribe to the onerous terms of the bailout fund. Why would the new government want to? Why not just default and see what happens?
Well, the problem with default is that you still have daily operations of the government to run, essential services. And if you're running a structural deficit, default is not necessarily going to get you there. So there are painful cuts that are going to have to be made in the budgets of these countries in order to bring revenues in line with expenditures. But then, assuming that you can fund your own operations from your own internal resources, then default is an option.
Okay, if we look at, again, go back to Portuguese debt, the 10-year yield climbing to that 8% level, the highest since the Maastricht Treaty was first adopted almost more than 20 years ago. What is this ultimately going to mean for Germany? If the rates of the peripheral borrowers continue to climb, is that not ultimately going to come home to roost for some of the stronger credits like France and Germany?
Yeah, look, I think that what's being tested here is the integrity of the euro, and the peripheral defaults by peripheral countries on their sovereign debt will likely raise the cost of funds for everyone, even slightly. And so, the risk of a default here are twofold. One is the cost of funds goes up across the Eurozone altogether. And secondly, significant default with significant impairment can have effects on the banking system in Europe, as the biggest creditors of these nations are, in fact, the biggest banks in the Eurozone.
Jim, thanks so much. As you point out, it is a very tricky balancing act for the EU and German Chancellor Angela Merkel. Jim Millstein, former Chief Restructuring Officer for the U.S. Treasury. Good of you to join us here on the Inside Track.